Where's the start the webinar? Did you start it? Oh, you did start it.
Yes,
Yay.
I did.
Okay, good. All right, good. So door is open. That's good. Welcome everybody. Let everybody get a chance to get in and get settled. Tony, you want to put a little introduction into the chat? And then while you're doing that, the only other thing that I have to do is, if we don't put my phone on do not disturb, that's going to be a problem. There's my phone. And do not disturb. All right, perfect. Excellent, excellent. All right. All right, good. Hi, Judy and results. How are you guys doing? As always, if you guys don't know what the format is for this program, all the communication will be done via the chat box. So you guys will have an opportunity to interact with us, ask questions. Hello, Marie. Ask questions and interact with us. So because of my screen setup here, I've had to put the PowerPoint a little bit to my left. So you guys will probably see me reference to my left if you happen to be looking at the little box that's got our heads in it. But other than that, we're going to let everybody get into the presentation, which is good. And again, we invite any questions that you guys have. This is going to be our last presentation of the year. We're going to be taking December off because, well, it's December. So let's just call it what it is. Let me adjust the camera a little bit. There we go. So it's December. We do have some programs coming up in January that we're really excited about. Actually, we've got 4 webinars on the books. Oh, actually 3. Sorry about that. I didn't see that. So we got 3 on the books for January. We're going to talk about that in a little bit. So we're going to get started on this. Some of this is introductory, so it'll give some folks a chance to unwrap their Jimmy John sandwich. Speaking of which, we're still waiting for our sandwiches over here, but hopefully you guys that did get to order got what you ordered and are enjoying that. So on to the program. So we want to talk about down payment assistance and zero down loans. And so what we've done today is gather a bunch of information about the products that we have available, the ones that we know work, and the ones that we think are the most beneficial to the clients. But first, we want to talk a little bit about, we'll talk briefly for those of you who don't know me. I'll back up real quick. For those of you who don't know me, Rich Kimball with Cross Country Mortgage. I have been in the business for over 30 years. Stopped counting after 30 years because I just start dating myself, but been here with Cross Country in January. It'll be 10 years. We were actually the first brick and mortar branch in the state of Illinois. Now there's probably close to 20 or 30 brick and mortar branches here because of the acquisition of companies like Pearl Mortgage and B Mortgage. We have a pretty significant footprint here in Chicago. Moving on to the company. So relative to Cross Country Mortgage and our growth, right now we're one of the top 10 retail lenders in the United States. It's really incredible growth since I joined the company 10 years ago. We are headquartered in Brecksville, Ohio. Being headquartered in Brecksville, this June, we actually broke ground on a 260,000 square foot headquarters facility, which will be close to downtown Cleveland. Right now, we're in suburban Cleveland in a town called Brecksville, but we've outgrown that building so many times, it's not funny. Part of that is because of the amount of employees that we have. When I joined the company 10 years ago, we had less than 250 employees. As the slide shows, we've got over 6,500. We're estimating by the time we get to the end of the year, we could have closer to 7,000. And a lot of that growth has come in the last 2 years. Just in 2020 alone, we brought on close to 3,000 new employees. As far as branch network, our branch network, we've got 500 branches, 500 branches around the country, and over 500 branches, that is. And we are a national lender in all 50 states. And I want to point that out real quick because I know a lot of agents have been telling their customers, and I think even KW was leading with this in a lot of conversations over the last 90 days, hey, if you're buying a home in out of state, whether it's Tennessee, Florida, Texas, Wisconsin, Indiana, let me, the realtor, know. Well, that also applies to us here at Cross Country Mortgage, because we can lend in all 50 states, and I can do that right here out of this office. So we take care of the processing out of this location. We do have a licensed loan officer out of our corporate office that actually communicates with the borrower, but the processing and the closing of the loan happens here under our supervision, and we know it's being taken care of. We've currently got loans in Nashville, Florida, Michigan, Wisconsin, Nevada, and California that are being processed right here at our location. So, and then we will go on to the next slide. So this is all about putting homeownership within reach. And basically there's a couple things that, there's that down payment myth. So that myth that says, people need 20% down. And as much as you and I know that's not true, the consuming public doesn't. Here's some statistics. Recently, they did a survey of millennials. Now, millennials are important because that's our biggest first-time home buying segment. 2/3 of millennials haven't even entered the purchase market yet. So they're coming, and they're going to be coming in waves. And they're partly the reason that we've had this very strong this very strong purchase market, just because the number of millennials, we've talked about that. The number of people turning 33 this year was higher than last year. It's going to be higher next year, and it's going to be higher the year after that. There was a baby boom that happened 33, 32, and 31 years ago. And why is 33 important? It's kind of the magic number for millennials. Most of them at 33 hit that purchase market. So why we talk about them is because they were polled. I want to say it was a website out there called NerdWallet, which is a really popular site. They polled a bunch of millennials, and they were told in the poll, over 70% of them, 70, 2/3, thought they needed 20% down. I mean, that's just a message that's still out there, and it's a message we as agents and lenders need to talk to people about and say, it's really not necessary to come in. As a matter of fact, because they're struggling with high amount of student loans, they're sometimes having some challenges saving money for down payment. And so these no down payment loans or down payment assistant loans can really, really help out. So it's one of the other reasons we wanted to do this today. Fact is, NAR did a study recently that said 73% of all buyers that needed a mortgage came in with less than 20% down. So we know it happens, and we know it happens quite a bit. So, 3 and 3.5% down loans are pretty common, 3% being conventional, 3.5% being with FHA. There are some other options out there. We're certainly going to talk about that today with the down payment assistance and or zero down program. So we'll switch our slide over to our first program. So this is FHA with, and by the way, please throw in any questions as we start getting into the programs. I'm sure you guys are going to have questions. This is an FHA program that is not IDA. So it is specifically FHA only. And what it does is it provides down payment assistance anywhere from 3.5% or 5%. Now, the down payment assistance on this particular program is repayable. So that's a big difference from IDA. With one of the programs, it's not repayable. This one, however, is. But I want to tell you what some of the strengths of this program is in comparison to IDA. One of the positives with the program is you can get 3.5%, a true 3.5%. With IDA's $6,000 down, that being maxed out at 6,000 for that free money that IDA has that's forgivable, that's a 3.5%. It represents 3.5% of $174,000. If your client's buying 250, 275, 300, that $6,000 isn't even covering the 3.5% that they need down, not to mention the closing costs and other things. This program is 3.5% down of the purchase price. So there isn't necessarily a limit of 6,000. There's not a hard dollar amount limit to this. So your clients can get anywhere from 3.5% or 5%. Now, it is repayable. It clearly says that on the slide. It's repayable. The term on it's about a 10-year term of repayment, and they're charging 6%. But your clients have a way to get into the market now, which is better than sitting and waiting and renting. And we'll talk about rents for a second. You know, the average rent in the United States is up about 10% year over year. Renewals are up about 8% in costs. In other words, the amount of money that a tenant pays, if they're renewing, they're paying on average about 8%. If it's a new lease, the landlords are getting 12% more than they were getting last year. So getting into a house where you have appreciation on the house and you can avoid throwing extra money away, even if you're going to pay some of this money back, it's still a much better deal. All right. So this one other thing on this one. So with this program, similar restrictions to IDA with regards to credit score. Credit score minimum is about 640. Now they do go up to 50% debt to income. That's higher than IDA. IDA is capped at 45% debt to income. One other thing that I would talk about this is the income limits for this are a little bit lower than they are currently for IDA. Income limit right now in our market is going to be about 93,000, 93,402, whereas IDA is closer to 111,000. But honestly, at 93,000, that's about $7,000 a month. It's going to qualify you for most FHA homes, providing the borrowers and carrying a lot of other debt. So it's a good program. The FHA limits do apply. The current FHA limit on a single family is 379.5. This program is only for single family. It cannot be used to purchase a 2 or 3 or 4 unit owner occupied through FHA. So that's this program I like because it gives our clients more money to work with. They get a true 3.5%, or in the options that they take the 5%, they actually get the 5%, which they can use the other 1.5% towards closing costs, which in this market really helps when we have sellers that are not really willing to pass on closing costs. All right, so we're going to get into IDA and some of the other programs later. I want to pivot a little bit to our doctors and physicians program. So there are products out there. If you choose to market to doctors, physicians, veterinarians, pharmacists, if you have access to any of those types of folks, there's some really aggressive lending out there. Now, we have a lot of different programs. Originally, when I got this slide deck from our corporate office, they had a whole slide in there about a little bit smaller loan that required mortgage insurance and maybe required a little bit of a down payment. But then we had this slide where we talk of larger loan amounts available and pretty much no mortgage insurance. So I want to kind of go through this with you. Again, one important thing, it is for doctors, dentists, veterinarians, and pharmacists. So they can come into this product with no money down and have no mortgage insurance. Keep in mind, when there is no mortgage insurance, typically the mortgage rate's a little bit higher because the lender is taking all of the risk. The other thing that's unique about the program, and this one in particular, is they will lend to the medical professional before they start their job, providing that we have proof they have a job and what those terms are. So a lot of times a resident will come out or graduate college, they'll be offered a position, they haven't quite finished their schooling, but as soon as they walk out, they've got a job lined up at a local hospital and they're ready to go. If we have those agreed to contract terms, we're going to take that as income and we can close before they even start their job. The other nice thing about this is that a lot of these folks come out of school with student loans. And as we know, that's a big burden, especially to our millennials, but it's a big burden because those student loans are calculated in against their income and sometimes will hold them back for what they qualify for. Under the doctor program, most of them, if they can prove that the loans are deferred, the payments are deferred for at least 12 months, they're not counted against them. That's very different from normal conventional and FHA lending. So, all right, we also have other quick requirements on this particular program: 700 minimum credit score, debt to income up to 50%, and loans up to $2 million. This is a great program if you as an agent have some sort of niche or access or way to market these professionals. I would reach out to us, and we will create a flyer that will help you promote this, whether you want to promote it in social media, whether you want to promote it as something you can hand out. Reach out to us, we'll get you a flyer. So Mari asked a question: there is a practice time limit? So doctors practicing over. No, that's any medical professional would be eligible. Obviously, when we start talking about no money down, you think maybe a doctor that hasn't come out and hasn't started earning yet. But candidly, if the doctor's been in the profession for 10 years and maybe they just used all their money to buy a building to put their practice in, but now they're ready to buy a house, they could use this program. So they could be in practice a while. That's kind of irrelevant. So all right, so any other questions on that while I grab a drink? Thank you, Mari, for the question. All right, moving on to a different, to talk about changing gears a little bit. So the USDA is basically a loan for rural housing areas. So a lot of people hear USDA and they immediately think farms. Oh, we got to lend on a farmette. Actually, the opposite is true. The USDA doesn't really want to see any kind of cash generating business on the property. Will this apply to a farmette? Sure, we could use the product on a farmette, but a farmette for somebody who has a hobby. I have friends of mine bought a home up in, gosh, where is that? Wonder Lake, outside of Wonder Lake, and they're into horses. So they've got a couple horse barns in there because they own a couple horses, but they're not making money on having those horses there. There's a big difference there. So with this particular product, and this is something where I'm going to actually, we're going to switch. Let's go back here. We're going to jump screens because I want to show you with the rural development. So you don't hear about a lot of it here because of where we can lend on it. I want to show you guys a map where you can lend on it. And there's a lot of communities that you've heard of, that your clients maybe have indicated some interest in. And candidly, since I don't know all the audience that's here checking us out today in our presentation, you may already be working in some of these areas. So we're going to switch over from the presentation slide for a second over to the map, and I'm going to show you what areas are eligible. And this is a map that you easily have access to. So we're going to stop the share there. You guys can see me now. I get to share the screen over to the map. So now you should be able to see the screen. Tony, let me know if we could see the screen. This is a map.
You got it, yep.
Perfect. So this is the map of, this is the Illinois-Wisconsin border right here. And if you'll notice, this is the United States Department of Agriculture, Rural Development. It's a pretty easy map to find. If you open up your browser and put USDA loan, you're going to be able to find this stuff pretty easily. So this lovely mauve, I'm not sure what color you would have, but this lovely mauve stuff is what's not eligible. So if you're in this area that's where Spring Grove is, or Channel Lake, or Antioch, or Greenwood, and Wonder Lake, we just talked about Wonder Lake, none of this is eligible. However, Richmond is eligible, Hebron is eligible, and what's actually a little bit more fascinating, quite a bit of southern Wisconsin, Elkhorn, Geneva, Lake Geneva, all of these areas are eligible for this no money down product. If we go, and I'll take you guys around the western border here, Harvard's good, Union, Marengo, and again, we're just going to kind of go outside Genoa, Kingston, Kirkland, and Maple Park, Caneville, we'll get pushed a little bit farther out. Somonauk, Lake Holiday. Let's see if we can tighten that up a little bit and get some more towns. There we go. I haven't heard of some of those towns. I'm only going to mention the ones I've heard of. So I know I saw something. There we go. Coal City, Wilmington, Elwood. So all of these areas would be potentially eligible for this. So Onia did ask for a link to the map. Tony, if you can get that in the chat box so she can copy that, that's perfect. You guys could always, if you're not sure, I'm going to go back up to the northern part here real quick. So if you're not sure what's eligible, so for example, there's portions of Woodstock that are eligible, portions that are not eligible. If you're not sure, type in the exact property address right there, hit go, and it'll tell you whether or not the property is eligible. So great product. Now we're going to go back. I'm going to leave this map for a second and go back to the slide because I want to share with you guys. There we go. Oops. There's the slide. Perfect. All right. So on this program, it mentions that there's lower fees than FHA. If I have a borrower that's buying in one of these communities, I'm looking at this program before FHA all day long for many, many reasons. Number one, there is no down payment with this program, where FHA wants 3.5%. And of course, we can get you there with down payment assistance, but this is a true no money down program. The other thing is that their fees are different. So FHA charges an upfront mortgage insurance fee of 1.75% of the loan amount. So just for raw numbers, if somebody's borrowing $100,000, they're going to have $1,750 added to that balance. That $1,750 doesn't come to me. It goes to FHA to insure all the other FHA loans. With a USDA loan, it's only 1%. So again, that's a considerable savings. Now you're financing 101 versus 101,750. The other part of the savings, we talk about the fees being less. Excuse me. The other part of the savings is the monthly mortgage insurance. With FHA, it's 0.85%. So for example, if it's a $100,000 loan, and on an FHA basis, if the mortgage insurance is 0.85, that's $850 divided by 12. That's what the monthly mortgage insurance is. On the rural development, and this is kind of new, they didn't used to charge monthly, but on the rural development, now they do, they're only charging 0.35. So instead of paying $850 per 100,000, you're only paying $350. And again, that both of those numbers are divided by 12, and it's just added in like monthly mortgage insurance. With rural development, they don't call it mortgage insurance. They call it a guarantee fee. It's the same thing. They're basically just giving money to the government so the government can guarantee to the mortgage lender they're going to get whole in case somebody defaults. But again, tomato, tomato, it's the same thing. It's still mortgage insurance. So, all right. We talked about what homes are eligible. Low to moderate income is important. There is an income limitation. I ran McHenry County as an example, and the income capped out at about 107,000 for a family of 3. Family size is important. So there's a quick calculator. Actually, that same place that you found the map, if you tab a couple spots over, you can calculate the income, or just come to me. We'll figure it out, make sure they qualify. The other thing is as far as credit is concerned, now north of 640, you can get what's called an automated approval through GUS, which is the government underwriting system. You can get automated approval through GUS north of 640. Under 640, that becomes what they call a manual underwrite. Those are a lot tougher to get approved through rural development. Rural development also underwrites all of these loans after we do. So depending on what area that you're dealing with, in other words, we've done some rural development in Michigan, we've done them in Missouri, we've done them in other states. Each of those states has its own underwriting department. You're going to want to reach out to your lender and have us confirm the underwriting turn times for the government agency. Here locally, I believe we're in good shape. Other states, it has run a little bit longer to underwrite those. But again, it's a great product. It's a no money down product. There's a lot of areas that are covered. Certainly, if you're dealing in southern Wisconsin, there's a ton of areas up there. Also, be kind of a cool product to market. You know what I lost was my chat box. Okay, good. I got a couple questions that came in. Was there a slide that showed the credit rating requirement for being just 580? Mari, are you talking about the rural developments? Yeah, don't say the rural development. We didn't have that in there. So Mari, if you can clarify what you're asking on that. Again, for rural development, it's 640 to get an automated approval. Under 640, it's a manual approval. So that's our USDA loan. First slide ahead up at 580. Let's see what she's talking about. I'm not sure. Let's go back. Well, Mari mentioned I had a slide that had 580, but I don't see it there yet. So I didn't see it as we go back. Oh, she's talking about the VA loan. So because we did accidentally slip over to the VA slide. So good timing. We're going to talk about VA loans. So all good. So these are for our veterans. These are for our qualified veterans. They have to be able to provide us what's called a certificate of eligibility. In order to get that certificate of eligibility, they have to have done one of two things. The first thing is have been called into active duty. So they were in the military, and yes, they were in fact got deployed. So that's one thing. The second thing that they would have had to do is just been in the military long enough to earn the points to actually qualify for the veteran benefits of actually having a VA mortgage. So one of the first things we do when we get a veteran in is we start tracking down that certificate of eligibility. The VA's finally caught up to the 20th century and made a lot of that process automated. As recently as 5-6 years ago, that process wasn't automated and we were sending things in and waiting to get things back. So we're now automated in our pursuit of a certificate of eligibility, and that'll tell us how much the borrower has. Now, interesting thing about that, a lot of our competitors will say that there is a cap or a limit on a VA loan. We at CrossCountry don't have a cap or a limit as far as the loan amount is concerned. A lot of lenders will cap their limit at whatever the conventional loan limit was. The conventional loan limit for most of the year was 548,250. Towards the end of the year, we've moved the conventional loan limit up to 625. A lot of lenders would tell you VA's capped at 625. They don't do any more. I will tell you that we have closed 7-figure VA loans here in the Chicago market, talking about 1.2, 1.5, even a $2 million VA loan closed right here in the Chicago market. So there is not a limit for the VA loan, providing, of course, the veteran qualifies for it. But you're also talking about a loan where somebody can buy a home at 1.5 million or 1.2 million and not put any money down. They're a qualified veteran. So, so keep that in mind. If somebody says, "Hey, my vet wants to buy 850," the lender said, "Nope, you can only get 6.25." That's a great referral for us. Let's see here. Closing costs. We talked about no mortgage insurance. While there's no mortgage insurance, the VA doesn't charge the veterans on a monthly basis. They do have what's called a funding fee. And I'll give you, there's a couple variances on funding fees. I'm going to give you the 3 most common ones that we see. First of all, what's a funding fee? It's a dollar amount that's added to the mortgage that goes to the VA that helps them insure all the loans to the lenders in case there's losses. So first time use, non-disabled veteran is going to have a funding fee of about 2.3% when they're not putting any money down. So 2.3%, there's some tiers where it can go down based on down payment, but we're just going to talk about the common ones today. If they're a second time user of their VA benefits, and the VA doesn't care if they use them 2, 3, 4, 5 times, but on that secondary use, they do charge more. They actually charge 3.6%. And again, that gets tacked on to the mortgage. So what do I mean? $100,000 VA purchase, no money down, first time veteran, 2.3%. They're borrowing 102,300. If they're a subsequent user, it's 3.6%. So that $100,000 purchase at 3.6%, they'd be borrowing $103,600. All right, now I said there was 3 things that we talk about when we talked about the funding fee. The other one is disabled veterans. Similar to some of the great benefits we offer here in the state of Illinois to our disabled veterans, if they are disabled veteran and they're receiving benefits from the VA, they actually qualify for no funding fee or 0 funding fee. So those are the 3 most common that you'll see. But again, there's no monthly, which is a huge hit. Talked about closing cost credits being available, of course, relative to the 580 credit score. This is what Mari was talking about. Yes, we can go down to a 580 credit score for the VAs or for the veterans. And that covers the VA side of it. If you guys have any questions, hit the chat. Otherwise, we're going to be moving on to the next slide. And the next slide is going to talk about something you guys all know about, and I could talk about in my sleep. No funding fee for disabled veterans. Yes, Marie, that is correct. There is no funding fee for disabled veterans. So that $100,000 purchase for a disabled veteran would be a $100,000 loan. So no funding fee. All right. So we come up to the Illinois Housing Development Authority down payment assistance. Also, the acronym you hear is IDA, IHDA. So under the IDA program, there's actually a couple different programs. That's interesting. It says 3, but there's actually, no, they didn't cover the other one. That's forgivable. Interesting. Oh, because they don't have the other one. Okay. So there is actually 4 programs that's available. The first slide references 3. The other program came back to Marketplace. Recently, there's not a lot of difference between the other program and the one mentioned in this slide. We have the IDA Access Forgivable. As mentioned in the slide, it's either 4% of the purchase price or $6,000, whichever's less. Now, the thing about that, it says right here that it's a true grant. It doesn't need to be repaid, unlike the first one we talked about. But it's what they do is they secure a second lien against the property. And at the end of 10 years, IDA will rip up that lien on this program. The program that they just brought back, and literally probably brought it back about 4 months ago, was exact same terms, 4% or $6,000, still forgivable. The thing is, they're tearing that note up in 5 years. So that, we believe, is a limited time only product. Everybody's taking that for obvious reasons versus the one on the slide here. IDA does have some limitation. IDA does have limitations. Hang on, I have a little internal text. No, Tony, I'll wait. So, okay. IDA does have some other limitations on it. Number 1, their maximum debt to income ratio is about 45%. Their minimum credit score is 640. They also require that the borrower get home buying classes or take a home buying class, which I strongly encourage anyway. One thing about the home buying class is statistically, somebody who takes that class is 33% less likely to ever default on their mortgage. So highly, if you ever have a client that comes to you and says, oh, my lender's asking me to take this class, they're going to be a better homeowner and honestly have a more successful home ownership rate than somebody who doesn't take that class. So just let them know there's a lot of valuable information in there. All right, so we talked about this IDA program, and now we're going to skip over. All right, the other 2 IDA programs that are available really boils down to both of these programs are repayable. The $7,500 program is repayable in a lump sum either when the borrower refinances or when they sell the property. So the note is placed against the title, just like the first one we talked about, but the note never goes away until they actually get their cash. The third one, which would go up to 10,000, to be honest with you, we've actually seen some people using this 10,000 for two reasons. Number one, they're getting more money than the 6,000. So if they are in a higher purchase price range, this actually helps them stretch to fill in that 3.5% down payment. So that's really important. You know, if you're buying, what do we got? If you're buying 300,000, then you're looking at almost 10.5 of a down payment that's needed, about $10,500. This 10,000 pretty much takes care of most of that. So the other reason is maybe it's not that as expensive a home the buyer's buying, and they don't need the whole 10 grand towards the down payment, but they can use it towards closing costs. That's really critical too when we're in this market where we have sellers that don't feel they need to give up closing costs because the market's so darn hot. So we've seen much more use in the last 6 months of this product than I ever had. So I could have told you a year or two ago that we're doing 99 of those $6,000 ones to 110. Now I would think that we're closer to doing probably doing 7 of the $6,000 down payment and maybe 2 or 3 of the 10,000 because people need the extra money. Um, ah, Great question. So Marie and Onia both asked the income limit, and I'm going to actually pull that up because it's roughly 111 here in the Chicago market. About 111,000 they just revised it within the last 9 months. It was 109. It went up to about 111,000. That would be your income limit in most of the local county, local or Chicagoland counties here. All right. Any other questions about IDA or any of the other programs that we've discussed? So let me know. I'm going to jump a slide here and jump a slide there. So also for us, so a couple of things, and you guys, we'll leave the chat open for any questions that you might have about the down payment assistance programs. Oh, keep in mind there is, and I'll actually get that to all the attendees, but aside from on IDA, aside from the income limits, there is also a purchase price limit. And the purchase price limit isn't based on FHA's max mortgage. So FHA's max mortgage is roughly 379.5. There's a price limit with IDA that's actually under that. I believe it's about 339 is the most that purchase price that you could have on a single family. So about 339. So they not only have income limits, but they have purchase price limits. So it's roughly 339. So keep that in mind too, because that's one thing a lot of people don't talk about. And I've occasionally seen that where somebody writes that up and they're ready to go, but IDA doesn't go that high. So they definitely have that limitation. Faster closing. So we talked about right now being able to close in 21 days is certainly for us, we're in great shape. What's the struggle's been for any lender across the United States is appraisals. And there is a significant shortage of appraisers, and there's significant volume due to the amount of refinances and the purchases that we're all generating. So we are seeing appraisal delays. In this market, they're not quite as bad as in other markets. And honestly, the fees are still a lot more reasonable here in the Chicagoland area. In California, for example, if you want to guarantee that you get your appraisal in under 30 days, it's like $1,200. So we're somewhat blessed here. Yes, they're a little bit slower than we like, but if we can get the appraisal turn times fixed, then we may see a little bit of that in 2022. We do think that purchases are going to be up. The Mortgage Bankers Association has said purchase mortgages will be up about 7%. And we're also seeing a higher percentage of people paying cash. So that's good for you guys. That may mean a net increase in purchases next year, maybe 10% higher, maybe 12% higher. We got more cash buyers, and we're going to be doing more mortgages. On the refinance side, obviously the rate and term mortgages will go away as interest rates continue to climb. What we are seeing a little bit of a surge in, though, on the refinances is people taking money out. Average appreciation in the United States has been about 20% in the last 12 months. It's really, really high. A lot of people have gained a lot of money in equity, and now they're pulling that out. Home equity loan lending is up almost 100% right now versus where it was in January. People are tapping into their equity to do different things. So I only bring that up because I think it's going to keep the appraisers running ragged a little bit, and I don't know that we'll see appraisal times turn as quickly as we'd like to see. Let's see here. We talked about cross country or offering more options. There's a lot of different programs that we've done for you guys, talking about no money down stuff, not no money down, but no income verification, and a lot of different creative things. Even this doctor program is really a creative product that you don't see in a lot of places. I always encourage agents, come see me with the borrower. Let me see if I've got a product for it. We're constantly getting new products as we're growing and expanding. And again, we're already a top 10 lender in the United States. We've got some great technology here. Obviously, to be a top 10 lender, we have to be competitive on our interest rates, and that I feel we are. So this is our last program for the year. I'm going to grab my calendar for January. So get a couple dates for save the dates for you guys that you can put in your calendar. January 11th, we are doing a program on, and I believe that is a lunch and learn. We're doing a program on HomeBot. If you're not familiar with HomeBot and you're trying to plan your 2022, HomeBot, for $300 a year, you can interact with every one of your customers cheaply via email. And anytime that they do anything that's real estate related, email comes back to you letting them know. If you want to know more about HomeBot, the ROI on HomeBot is crazy. So we're getting some response. Actually, a couple things in the chat. There is a link to register for our HomeBot presentation, and we've already got some fans of HomeBot telling us how they really, really are enjoying it. Anybody I've put into the program that's been there for more than 6 months has already seen the return on investment. So a lot of interaction that I'm hearing. People are getting deals, they believe, because of the interaction with HomeBot. We also have a home buyers class that'll be January 19th. This is a 1-hour class that's that's directed towards anybody thinking about buying. And notice I don't say first-time home buyers. This business has changed dramatically over the last 5 to 10 years. So anybody that's been out of the purchase market, even in the last 6 or 7 years, they could still get some value coming to this class. The home buyers class link is also available. If you have any home buyers that you want to push to it, it's great. You have any leads, people talking to you, I'm thinking about buying in the spring, send them to that class. We're going to educate them. We're going to get them excited about it and help them be much more successful home buyer. And our last one, and I'm really excited about this one, our last class is a personal budget webinar. So we're going to be teaching, this class is available not only to real estate agents, but also my consumers, or my customers, if you will. We're going to teach people how to do a budget. And the one thing that I want to talk to you about a budget, we're doing, I do budgets with my employees. I'm coached by some folks that have required me and my wife to do a budget every month for the last 5 years. It is a game changer. If you have this form, you go through it with your significant other, if you have one, and just show them what's going on. And one thing I'll say about the budget class, everybody hears the word budget, and it's if you're in sales, they talk about words that, oh, don't say this word or don't say that word. And I think budget's one of those words because people start thinking, they're going to tell me that, I can't spend money on this, or I can't spend money on this, and I have to be really frugal, and I don't want to live my life that way, blah, blah, blah. It's not what I'm going to say at all. What the budget class is is about tracking where the money's going, maybe setting a little bit different standards or priorities, and tracking some of the important things like how much did you save this month, or how much did you pay off on your debt? What debt are you carrying? So it's a really phenomenal class. I really encourage you guys. That's going to be Saturday, what did I do with it? January 22nd. We're going to do that class. Really excited about the class. Tony's put the link to that class. When you join that class, you will get a copy of a blank budget that you can prepare ahead of time, but then I'm going to walk through how to do it. And then, of course, if you have any questions, we can go through there. We talk about a lot of principles in that class. We'll talk a lot of principles that have been shared in the Automatic Millionaire, Millionaire Next Door, and things like that. The Latte Factors, a bunch of great books if you haven't. Richest Man in Babylon, all of those books I will reference as we talk about this budget, and I think it's really important. That being said, guys, I'm sad I don't have any of these to do in December, but if you guys have anything else that you need, please let me know. We're excited to be bringing this information over to you, and the information we have coming down the road, such as our classes in February, but we'll talk about that later. Thank you guys for attending. And Mari's already said that she's registered for the classes, so we're super excited about that. I hope you guys enjoyed your lunch today. I'm going to go find out where mine is. And thanks, Tawana. I will have a great holiday. I'll be talking to you, I'm sure, before that. Marie, thank you very much. Carrie, thank you. I appreciate you guys for chipping in. Gwen, I appreciate that. Thank you. Deborah, that's awesome. Monica, thank you very much. You guys are the best. Nia, of course. And Seema, of course. This is great. It's good to hear from you guys. Trisha, Kim, of course. Thank you guys very, very much. I hope you guys learned a lot. If you need anything from us, reach out, and have a wonderful week. Take care, guys. Bye-bye.